Welcome to the HC Commodities Podcast, a podcast dedicated to the commodities sector and the people within it. I'm your host, Paul Chapman. This podcast is produced by HC Group, a global search firm dedicated to the commodities sector. Today, we're discussing the macroeconomic and political picture and how that plays into commodity markets. Are we on the precipice of inflation, the breakdown in free markets, and is there really a hydrocarbon glut out there? And elements on the periodic table have gone parabolic, from gold to silver to copper to zinc. Is it molecules' turn next? Returning to the show is Jeff Currie of Carlisle, where he works in private markets in the commodities business, particularly in energy and critical minerals. Please do like and subscribe on the platform you're listening on. It really does help support the show. And as always, I hope you enjoy this fascinating episode. Jeff, welcome back to the show.
Pleasure to be back as well.
We need you, right? Because we've sort of tipped over from interesting times into slightly terrifying times. And there's so much going on, much of which commodities sits at the heart of it. This is sort of this commodity security story in some ways playing out, or at least used as the stalking horse for other geopolitical aims. We're going to get all to that. The bit that I guess I'm certainly struggling with is, what is going on in the global economy? There seems to be so many countervailing forces and stories out there. Some are inflationary, some are deflationary, some seem like we're on the brink of a recession, others not. At the same time, global trade seems to be shifting again, decoupling. I mean, can you help us understand where we are? And perhaps we can start with inflation and, dare I even say it, stagflation.
I think the bottom line is relative to where expectations were, let's say a year ago with the threat of tariffs, the world's a much stronger place than I think what most people anticipated. And when we look at commodity demand, whether if it's in oil and other commodities, it's been coming in stronger than expected. So from a economic as well as commodity demand perspective, while albeit it's not gangbusters, I would argue it's more positive than what would have been anticipated given everything that's gone on. Now, that said, I think the risk profile is not as great, at least outside of the US, than what I think many people would have thought, given the fact that you have so much fiscal underpinnings coming from places like Germany, Japan, the big beautiful bill in the United States. So you put it all together, the economic side of the picture, I would argue, is probably strong enough to reinforce those inflationary concerns. And I think that's probably where we really should begin these discussions. And you look at the market, whether if it's in break-even inflations, oil prices, and the rest of them, there is a unrelenting view that they can't go higher. Whether if it's the narrative around the big oil supply glut in crude oil, you look at the back end of the yield curve, 4.1% nominal yields, which is a nominal amount of inflation built in. You look around the market, the markets don't express any of these concerns about inflation, with the exception of gold and precious metals. But we'll talk about there's a lot of other drivers behind that. So I think there's a lot of focus, as you brought up. First word that came out of your mouth was inflation, but the markets do not tend to agree. And it's hard to argue if you don't have food and fuel as being a driver of stronger prices, then it's hard to argue for any type of inflation. There's a high correlation between, let's say, oil and energy prices and inflation. So I think that's wrong, and I think that's what we're going to be spending most of our day today talking about. But I think that the macro setup for 2026 is more than sufficient to be able to start to create some of these pricing pressures that are expected to be seen in 2026. And I would argue that the precious space is foreshadowing that more than anything.
Yeah. I mean, I find it fascinating. If you look at 2025, even 2024, and this is a little bit of this thesis around have the commodity cycles themselves not only sort of decoupled, we're seeing a different story in oil than we are in gold, than we are in copper, but also they've shortened from sort of this 10-year, whatever it is, 8-year, down to 2 or 3. But 2025 seems like the year that the dog didn't bark, right? I mean, also famously in emails, where we had the US and Israel bombing Iran. Oil prices go up and then they go down the next day. You have concern, even sort of the standard S&D world of, okay, Europe's going to start drawing from its gas inventories because it's going to be a cold winter, and then prices still go down in natural gas. I mean, commodities have done, with the exception of a couple, you mentioned gold, have kind of done the opposite of expectations, that just would signal and herald a very healthy supply and weakening demand for most of them across the board. So can you is that a fair perception? And again, it kind of this, everything's saying that, inflation shouldn't be worried about, but there just seems to be some nagging doubts about inflation being that kind of, you go bankrupt slowly and then all of a sudden, right? Which is what happened in 2022 with the second stimulus from Biden and so forth.
Yeah, I think the narrative out there is definitely one of oil supply glut. We have more than enough energy and food. Don't worry about it. And the way I like to characterize the commodity space is if it's got an atomic number and it's in the periodic table, it's going straight up. Silver, AU, AG, CU, like copper, all of them. Even zinc has joined the rally recently. ZI. So that group of commodities are doing really well. If it's a molecule and it's got a carbon and a hydrogen attached to it, God help you. And whether that's food like carbohydrates or hydrocarbons like oil and gas and coal. So the molecules are struggling. Now the molecules are the ones that drive inflation. You can let all those metals in the periodic table go to the moon. They're not going to do anything to inflation. Too small. And so if the government has an incentive out there to keep prices low in the commodity space, it's going to be all those molecules, the CHs, which is basically your food and your fuel. And we think about policy going back to 2022. It has been very much directed at containing the prices of both of these, whether it was turning a blind eye to Russia, Venezuela, and Iran and letting them ramp exports all the way back up to pre-war levels or pre-sanction levels. They've done what they can, or SPRs or whatever it takes to keep prices down. Also, I'd like to note that the week before that invasion in Venezuela, we had a record short in oil of 230 million barrels. Are these coincidences? Or are they planned? I don't want to get into that, nor do I have
Polymarket bets.
Yeah, but why would you be max short going into that the weekend before the weekend? I'm not. There wasn't any real news out there to drive a max short in there. But by the way, the ability to move prices around with that short is substantial. In fact, people make the point oil last year was down, $15 or whatever, something like 25%, I think it was. That short alone would have explained all that price move. So was there a fundamental move in prices over the last year? It's hard to argue with the size of that short. But I want to go back to 2022. And I want to take this back to our view that we were entering a commodity super cycle in October of 2020. And at that point in time, the view was based upon three big themes. One was deglobalization, meaning that, whether if it was through spending on defense or whether if it was spending for duplicate supply chains, duplicate industrial bases, whatever it might be, as we deglobalize, you're going to demand a lot for commodities. The second one was decarbonization. It's called electrification. And then the third one was redistribution, call it the war on income inequality. As you put money to lower income people, they were going to buy it. And it was these big three drivers that were going to drive that commodity super cycle. By the way, copper, gold, and the rest of them is pretty much played out as expected. Oil has been the laggard, and I would say food to a lesser degree. And a part of, I would argue, that caused this. And by the way, the underlying theme across all of this is the underinvestment theme, the revenge of the
Yeah,
old
yeah.
economy. Because they haven't built enough. Then you throw these demand drivers on top of it, it was going to put more pressure on it. When we think about those three drivers, they're they've been turbocharged since we put that view out. Deglobalization. I mean, it could get stronger by the day. And you need to build out more and more of your own supply chains, and you got to build your own military. All of that, very commodity intensive. The electrification story, turbocharged. Everybody's focused on, oh, the green is going to fall back under the current administration. By the way, there's no evidence in investment, whether if it's in Europe, China, or anything, that it's slowing down. You forget calling it green or ESG or whatever you want
Call
to
it
call it.
security of supply.
Security of supply. It's being turbocharged. And the electrification is going to be a part of that. Then throw in data centers on top of it. So that story is turbocharged from when we brought this out. And then when we look at income inequality and the spending, I mean, look at the big beautiful bill, and these governments are wanting to throw money at the lower income groups. So all of it's still very much intact. So the question you have to ask is, what went wrong with the molecules?
Well, is that because they were affected by those two things? So you take that thesis, and people should go back and listen to our first episode together where you lay that out. Is, of course, oil hinges both on governments. You hear it Trump all day long, despite wishing energy dominance, right? He wants low prices. It's somewhere, I think, in the administration's mind, we're set in 1976 or something. New York's awful, and oil prices are all that matters. But they want them low, and governments around the world do, right? Energy prices are felt at the ballot box, so people are subsidizing them. But also at the same time, that electrification story gets supercharged, and you just have to look at what's going on in Texas, right? 20% wind or solar renewables. Sorry, that is eating. We're seeing that absolutely in China. It is eating molecule demand. Are we to look at this? The super cycle is happening. It's just X out the poor old hydrocarbon molecule.
Throw in the carbohydrate molecule in there too. Right or wrongly, both Biden and Trump administrations were guilty of this. They think if they can keep those prices of those two down, they can keep inflation and at least affordability issues under control. And I think that your point about Trump wants, when I ask people about the mega short in there, I go, why are you short? And why would you want to be short in a market that's already killed off investment? You're too low for that. It's underperformed every other marker on the planet Earth in terms of its pricing. So if you put on a relative value, oil is just massively cheaper than what it looks like on your screen. And you look at demand, it's not slowing down. You have a record short. You look at geopolitical risks at very high levels. Markets backwardated. Inventories in the consuming areas are below the 5-year average. You have refining margins healthy. Physical grade spreads haven't weakened. What is bearish about this market, and why do you want a record short? Short answer is the most powerful man in the world wants it at 50, as you said. However, these are physical markets, and putting pressure on them like that, can eventually end up in a big repricing. But I want to go back to what went wrong. I was actually just let's ask what happened. And you look at the response in 22 and 23. They created more energy, more food, and more labor supply than you thought ever was possible. In fact, all the problems we have today are a response to that. Let's go over. Let's just start with oil. What was the best way to get it down? Just let Russia, Venezuela, and Iran pump as much as you possibly can. That's what they did. You just see it. They turned a blind eye to it. And then on food, environmental issues, cutting down rainforests in the Amazon or palm oil trees in Malaysia. Just let it rip. Get the food up as fast as you possibly can. And then on labor, open up the floodgates on immigration. I think in one of these calls we're talking about how the UK with 2x on immigration, the US was up 50%, and the Canada was up something like 3x. Bottom line, they got more food, more energy, and more labor by relaxing all the rules that were in place. Now, what are we dealing with right now? Venezuela, Iran. This is the give back to that. What are we dealing with? ICE in the U.S. It's the lashback to dealing with that last bout of inflation. Just opened up the floodgates to immigrants to get the labor price, get the wages down, and now you're getting the lashback on all of these things. And so I think the key point here is you created a lot of supply by pushing on a lot of strings, and everybody's focused on Iran and Venezuela creating new supply. They were already exporting as much as they possibly could given current conditions. But you're not getting any supply out of these two places for another 5-10 years bare minimum. I like to point out the time period between when George Bush Jr. landed on that aircraft carrier in 2003 for mission accomplished, and the time you saw oil supplies coming out of Iraq in any volumes was about a decade. And Iraq is in way better shape than what Venezuela or Iran are in today. So I don't think the supply side of that is not what needs to be focused on. I think that really the critical point of what's going on in the world, and you see it in gold, is the geopolitical implications of Venezuela are huge for the oil importing countries of the world: Europe, India, and China. And what are you going to want to do? Hoard. Build precautionary inventories of everything from food to energy and everything you can get your hands on. It's just too dangerous in this current environment. You got the Americans boarding tankers. And so I think the geopolitical side of this thing is far larger and more important than the fundamental oil supply side of the equation.
Yeah, and that's the. I mean, we did an episode, Emergency Pod, where we had a Greenmantle chap on, Nick Kumleben, and and this was a couple of days after, but it feels Venezuela wasn't about the oil. They might have sold it to Trump himself on that, but it wasn't about the oil, right? But what it has done is a continuance of that. Let's put it under the bucket of deglobalization, which is we're in a world of power politics, not rule-based politics, and that in some ways is set up against both the way the markets have been structured, but also the economies themselves, right? And this all predates. I mean, China's been building its SPR all of last year. As you say, gold is a story in that as well. And just going back to that super cycle thesis for a second there. So all of those three were ripping. The bit that then kind of, I guess, did get constrained first, because we had a banking crisis very early on. I guess the bit that wasn't accounted for was Russia's invasion of Ukraine. And then, which I think is in some ways the first war of the energy transition, but then that triggered a banking crisis, a credit crisis, that then suddenly meant the money supply was constrained. And that's what kind of nipped that commodity super cycle, or at least probably delayed it, would be the argument out of this discussion.
The way I like to phrase it, it just went too high too fast. Actually, if you look at a chart of like copper and the metals, and you just look at them since October 2020, take out that huge explosion in 22. It's just kind of a steady line up since October 2020. Our target was 15,000 in 5 years. We got the 13,000 and change in 3 years. I guess we're pretty
well on the way.
We're on the way.
The energy and resources sector is experiencing unprecedented change. To help navigate this change and capture its opportunities, HC Group launched Enco Insights, a global advisory network dedicated to the sector, providing senior advisors and subject matter experts to investment and infrastructure funds, law firms, and corporates. Enco Insights leverages HC Group's 20 years of connections in energy and commodities to give clients the expertise they need when the stakes are high and insight matters. Learn more at encoinsights.com.
But lots of volatility within that, which again signifies these sort of fraying markets, and also this swing that you and I spoke to in our last episode about back to government intervention.
Yeah.
And And let's that really is the story, and that's really the challenge and of the volatility in these markets. Are you a buyer of that thesis? We'll come back to the economy in a moment. Are you a buyer of the thesis that 20 years ago, 30 years ago, 50 years ago, the world moved much slower? Commodities, essentially commodity cycles were ultimately tied to the capital base, capital cycles, and it took 10 years to make a mine. It took 10 years to drill put a hole in the ground, off the coast of Venezuela or whatever it might be. And that really determined a 10-year cycle. But today, we're in a world where you've got much more cycles more often with higher peaks and lower troughs. Or is that actually just a rough journey on the way to a super cycle?
I think the super cycle was never a big super cycle. Think about the one in the 2000s. It was a spike in 0405, another spike in 08, another spike in 2010 or 11. That was enough to create the shale revolution and game over. That was in oil. It's similar for that. You think about the 1970s, spike in 73, another one in 78, another one in 80, 81. That was enough to create enough North Sea supply, game over. Even the inflation, you can see the big spikes. They feel like they were this upward steady trend in prices, but the reality is they were just a sequence of 3 or 4 big mega spikes. And I think that dynamic, because by the way, when you look at the physical capital story, it looks like what you think. It's a 10, 15-year cycle. That hasn't changed. Yeah, maybe you got some just-in-time inventories, but the physical world, you've got the ability through tech to speed up deliveries. It still takes time to put steel in the ground. And the other thing that I think people are missing here is the U.S., the reason why you think the cycles all got quicker is the U.S. was that asset-light software model, infinitely scalable at almost no cost. That party's over with. The big asset-light companies, the Googles and the Amazons of the world, they're putting steel in the ground through their hyperscalers. They're joining think about this, in the Exxon and, the big oil majors, on average, they spend about 60% of their free cash flow on investing. This group is now exceeding that. I think they're at 83, 84% now. And some of them are over 100%, like the shale guys were in 2013, 2014. These guys, when they were back in the era of, asset light and infinitely scalable models and software, they were putting maybe 15, 25% of it into the ground. These guys are acting like commodity producers now. And by the way, what's the multiple on an oil company versus the multiple on one of these asset?
Yeah.
It's like
10 versus 100, 300, right?
These guys are going to get re-rated. I don't care if people want to call it a bubble or whatever. Bottom line, they just need to be re-rated. It's, they don't function like, I guess another way to say it is probably the world's becoming asset heavy. And we're going back to the old world where you got to, put steel in the ground, which is another way of saying why you want to be long all the real assets, the bottleneck on this thing, because that's where the issue is going to be. A problem is there. And then when we look at the amount of investment in all of these spaces, there's all this talk about power and everything in the AI race. You really haven't done much to grow it. And you've got rising pricing pressure of power prices in the U.S.
Very little dispatchable power has been built in the last 20 years, right? And that's stark in markets like ERCOT, which is experiencing some of the highest growth of these hyperscalers, and also just domestic demand as well. But everything's been geared towards renewables, great. But actually, the market structures incentivize not building the bits you need, which is nukes and cogen and all the rest of it that's on irrespective of the weather.
Yeah. And you look at all of this, you still haven't invested. Like right now, this quarter is the last of the big major oil non-OPEC projects that will be coming online. And then you look at refineries, 2027, it starts to it's done and over with in terms of new refineries, because we never thought demand was going to grow. It goes back to the point, demand's not great, but 1 million barrels per day type year over year demand growth is far above what anybody would have expected 5 years ago. So the
This
demand
is the
is
big.
much higher, and I didn't ever answer your question about all of the decarbonization or electrification of the world right now. This point right now, it's transportation is hard to electrify, and that's what oil goes into. In the power gen, absolutely yes. You're impacting the other sources, but for oil, anything the EV picture has slowed down. I think going back to the AI race, AI, the bottleneck is going to be power and commodities. And China's light years ahead of the US on that. I mean, they're building out grid, whether if it's solar, wind, nuclear. And by the way, they don't do this to save the world. They do this to create energy independence.
Yeah.
All of it was done. EVs. It's just, I think if there's one message to give the policymakers, stop thinking about this stuff as being green and eco and get out of that debate. That debate was, circa 21, 22. This is
Yeah, and
about,
it's not even true, right? I mean, in terms of the actual manufacturing,
yeah.
yeah, this is security. Well, I'm going to come on to that because I'm going to channel your comments you made at the FT last year, but just to nail it down, we're seeing prices rising in those elements, and a lot of that, we need to figure out why that is. But molecules alone, in fact, oil inflation adjusted is basically at an all-time low, right?
Yep.
At $50, it's more like $20 if you adjust it for inflation in the last 20 years.
Absolutely.
Okay, so that's an interesting analysis that actually these commodity super cycles are really sort of like three big spikes, and we just push them together, but they're sufficient to make big changes in the capital investment, which we're definitely not seeing right now.
The spikes, the way I phrased it in 2020, is the highs are higher each time and the lows are higher. And they start to become more frequent. I will say the drop from 2022 has lasted a lot longer than I ever thought it could. But I think a lot of that
does it herald a new one, right? Like, we just had one big spike, or maybe two, and if you using history as our guide, we've probably got a second or a third one in our future because of, what we're definitely not seeing is a change in behaviors with respect to oil.
Yeah, by the way, if anything, the demand outlook over the last 12 months got stronger because of the loss of EVs on a structural basis. On the supply side, the fear mongering around the oil supply glut has created a lack of investment. So you got behavioral changes that actually reinforce higher prices, not lower prices. And this glut story has been in the market since August of 2024, when OPEC first started raising production. We're now, how many months? 18 plus months into this oil supply glut? Where is it? And by the way, you shouldn't be having to scrape the data to find the evidence of this if it's a real glut. These things, Paul, you and I have lived through these things. These things hit you over the head like a sledgehammer. You don't have to go looking for the data. And they don't happen in backwardated markets. They don't happen at $60 a barrel. They don't happen at with margins, healthy refining margins. They don't happen with healthy physical grades. It's like that's the part I don't get. There's no diversity in views. Max short, everybody's leaned one direction, but the data supporting this, it's the most convicted view. I've been doing this for 3 decades. I have never seen a view in any commodity market so convicted one direction. You can see it in the data. And it is convicted with something where it really can't even see the evidence. So that 4 million barrel per day surplus or whatever, the numbers are so large, but there's no evidence of it. Even if you take all the fourth quarter build, I think it's Goldman's view, their numbers had like 650,000 barrel per day build in fourth quarter. A lot of that's seasonal. So where is it? That's even doing the floating at sea and all these other things. And there's real reasons why you have a big amount of oil floating at sea. A lot of that
because large bits of the earth are shut down, right? You can't go.
Yeah, you can't touch it. And by the way, everybody goes, will it come? I go, Paul, you and I are old enough to remember that Iranian oil was sanctioned by Obama in 2012. It didn't come off those ships until 2016. It can sit on those ships, and that was 80 million barrels. And most of that stuff was condensate and never really impacted the market when it finally came out. But I think, there's a lot of explanations for what's going on. I like to point out there's only one group who has any clarity of what happens to demand in the emerging markets, and that's OPEC. Because they're ones selling down in there. They don't have the same type of big surpluses being forecast. But the part of this that I simply do not get is the conviction in these shorts around something that doesn't have. I've seen better trades in my life than being short oil right now. I'm not trying to dispute the glut story or anything like that. I'm just going, why? What are you playing for? Why do you want to have a record short in a market that's already, everybody is consensus view? You cannot seem to get this thing under a Brent basis of 64 this morning. You can't get it down sustainably below 60. And you've waited for that big floating oil at sea glut to come to shore for almost 6 months now, and it hasn't. I just simply don't see what people are playing for in this. But if I go out on TV and tell the story, the amount of comments I get back, vicious ones, is telling you people really believe this one. I can find you better things to go put your money in.
Well, and the other challenge there is everything is so sort of amped and hyped, right? I mean, the challenge of the S&D breaking through in a world where an email can get sent on a Sunday night. We're recording Monday morning. This will go out next week. I mean, that can upend the world, right?
Yeah.
I mean, we'll end up there because I do have this sort of fundamental question about kind of the breaking of markets. At some point, are we just going to revert to bilateral contracts because the nature and structure of these commodity markets as we built them rely on kind of international law, no less and less government intervention, private companies doing business, and at some point, if you're subject to a sanction overnight, what happens, right? Just one bit on, just to pin it on AI. Is fascinating comment on they are becoming they need to be repriced because they're becoming sticks in the ground. Is there a sense, how confident are we that itself is not you're getting discounted if you're not dealing with hyperscalers at the moment and so forth, and actually we might be way overbuilding capacity because chips get more efficient, more effective, more power efficient, all this kind of stuff, or indeed, we all stop using ChatGPT just to sort of, I don't think this is going to happen, but the actual use cases of ChatGPT are pretty asinine at the moment for the vast majority of people.
By the way, I wrote this piece titled "How Much Does AI Rhyme with Shale?" With the A and the L in shale capitalized to look like AI. The two stories are almost identical.
It's a massive sort of American sort of land,
Oh yeah,
shell game.
By the way, it's almost like these investment bankers took the pitch books from the shale era, raced out the names of the energy guys and wrote
get a permit, do some land work, and then flip it to the next guy for 10x.
The only difference is the shale guys did all of that contracting into the pipes, and then they gave them those guaranteed contracts, and then the pipe guys would go out and raise money. They go from the data centers upstream into the power. Other than that, it's identically the same structure, same financial engineering, same everything. Now, I like to go back in 2013. The world hated tech. They go, tech is just, they were like, there was no worry about a oil supply glut in 2013. All you want to do is own energy. Microsoft couldn't do anything right. You didn't want to touch the NASDAQ. And there was no, in fact, they were talking about peak PC demand. It's over with. You don't want to be in tech. And fast forward, 18 months later, NASDAQ is ripping and oil is at $25. Which, they didn't, it wasn't that they underestimated the demand for oil. It's just that the engineers, I have a saying, don't bet against an engineer. Give them enough time and money, they will solve the problem. And they massively increased commodity supply far beyond what anybody thought. And let's go to today. There's no worry about a AI compute glut. A lot of worry about an oil supply glut. So the mirrors of where we were in 2013, it's almost perfectly reversed. So there's no worries from any investor of an AI compute glut. You know what was interesting? When I wrote that piece, I had a picture in there that shows the price of AI compute. It's a commodity. You can trade it. Bloomberg has their Silicon H100 price index, and by the way, it's done nothing but go down.
Yeah, I mean, markets solve for it, right? I mean,
Yeah.
like, you know,
By the way, but I was going
it's
to
the
say,
blind, it's the your blind spot that you're not solving for. I mean, which is interesting, right? Because I think the chips are going to use less power. If
yeah,
that becomes the rate limiting, they're going to use less water and so forth, which is a negative. I mean, this is the complexity of this. You deal with it all the time. I just find it fascinating. Obviously that's not a very good story for, a lot of natural gas and power rests on an AI story. And what's sort of forgotten there is sort of as you say, the molecule story behind all of that.
by the way, one thing I wanted to make the point on here, two things. One, when I published that piece, nobody knew that there was a commodity called AI compute. Yet they're pumping trillions of dollars into this, and they don't know they can follow it just like the price of oil. And by the way, it's already flashing like 2014 in oil. That aside. But the other thing that I found interesting, went back and looked at all these big technological revolutions. Almost in every case, the equity holders end up with a donut. Whether if it was shale, railroads, whatever it might be, the bond holders get made whole. Managements make out like the best bandits, and then governments do well because they got the technology. So everybody but the equity guys do well. Every case. So may I ask you why everybody's piling into the equity of this? There's no history they'll get paid out. Because what happens is they end up killing themselves with too much investment. Going back to your question, you end up with a glut on this in the end. And I think your point, whether the chips or not, I go, don't bet against an engineer. They're getting better and better at. And then think about Saudi Arabia came in with its price war, and finally destroyed the shale guys, and what really caused the equity to go to zero in 2015 and 2016. The reality is, in this case, China AI is Saudi. That they can come in and undercut this. This is just like you see these stories over and over and over. How come you want to be long the equity when you know history does not paint a good picture for any of these technologies? But here's a broader point. This brings into Europe, and why I live over here in London. It's a fixed income currencies and commodity culture. It's not an equity culture. It's more lending. And so, we ask about, well, the innovation happens. Yes, he takes the equity to create the innovation. But it's a moonshot for some, but the rest of them don't end up with too much left over when it's all said and done on these. But, so that the equity culture of America, the fact that they do this is a great thing because it creates the innovation, but the track record isn't good.
Yeah, there's a book I've just finished, which you must read if you haven't, called Cattle Kingdom by Christopher Knowlton. And it is the rise and fall of ranching, cattle, beef in the 1870s, 1880s, 1890s, and it's absolutely fascinating. And every single kind of the step in that process, from at one point, being like 30% of U.S. GDP to basically zero, tracks, right, from innovations of cattle towns through to innovation of refrigeration. Just fascinating, and all takes place in sort of a span of 25 years.
Cool.
Or so.
That's it.
It's really good. Yeah, Cattle Kingdom. There's one for listeners to try out. But yeah, great book. Okay, that again, fascinating insight. And I guess just one final bit on oil, because what makes, there's no narrative out. Well, what makes oil go to 100? Is that even feasible anymore? Are we just simply saying that 60? There just seems this fundamental sort of flaw around that price, which belies this idea of a glut out there. And actually, if we just see demand kind of continue as we're seeing it, and that lack of investment, oil's just good for another 20 years kind of story. Or is there something out there lurking that could make it go parabolic again?
The gold and copper have gone parabolic, and there's no shortage. Where oil goes is, the upside here, I think, is extremely large across the entire commodity complex. Let me give you an example. I think we're going to go through a macro repricing It'll end up being rates, oil, everything. And we've lived through two of them in our lives. And I'm going to go back to the one in 2014, 2015. It wasn't the collapse in oil prices. It was a macro repricing. And to make this point, in 2012, you took a pitch book from a private equity deal for an oil field in Canada at $110, $120 oil that they were using back then. And you look at it, it had an IRR of 25%. Fast forward to 2016, take the same deal, $40 oil. What do you think the IRR was at $40 oil? It wasn't 25%, but it's not as bad as you think. It was somewhere around 19%. Why? Because everything repriced. The price of steel, the price of copper, the Canadian dollar, interest rates, everything repriced. So yeah, it wasn't like the whole world fell out of bed, but what it was is the capital moved out of the old economy and went into the new economy. Because by 15, 16, they go, hey, maybe there's something to do with this tech. And by the way, they were chasing Uber and like the Airbnbs of the world at that point.
the zombies that ate all that cash.
Yeah. But the point being is everything repriced. And nobody thought oil could have gone down from 100 all the way to 20. That was repricing macro. And by the way, it happened so fast. So you remember, we come in every day, oil down $7 or $8. The euro, collapsing from 120 to 115, 115 to 110. And every day you come in and everything moves. Interest rates, currencies, everything reprice, and boom, you hit bottom. And China was pretty sick at late 2015, early 2016. Voila, we've been in that world since 2016. And I think, the question is, once you get panic set in, let's say now I start hoarding oil. I'm China. U.S. has boarded these ships, the dark fleet ships. World's not looking very safe anymore. Let's say I take all that glut. Why wouldn't they? It's their ships anyway. There's 300 million barrels sitting of Russian and Iranian and Venezuelan oil floating around out in the South China Sea. And by the way, people look at that glut. That may be their strategic reserves. They own the ships. Just let them sit out there. So is it a glut or is it China's? I think that if we saw it, here's the way I like to think about what happened in gold. First was 2018. Mnuchin and the Trump administration, first time they used sanctions, treasury-based sanctions around SWIFT.
Messing with the dollar.
Yeah, right. And from that point forward, the Russians sold 93 billion U.S. treasuries, bought gold and physical greenbacks. Pallets of physical greenbacks were flown into Russia, so if they had to pay something in dollars, they used greenbacks so that nobody could take it from them. And then 2022 happens, U.S. freezes Russian central bank assets, gloves are off. You don't trust the U.S. government. You don't trust dollars. You don't do anything. You de-dollarize. And that's when gold just went parabolic. Because you had to hoard the gold. Mm-hmm.
Yeah. So that fundamental repricing, it seems like that would all circle around the dollar, and some of the pieces are on the board to make that happen.
Yeah,
correct me if I'm wrong
all
here.
you need is oil to fall into that mix. I think copper is getting into that, is starting into that, and then you just fundamentally revalue these things. It has nothing to do with everybody's counting barrels and economics. I look back at the 2000s. Fundamentally, you had no shortage. You never did. The market repriced.
Hello, I'm David Hunt, founder and managing director at Hyperion Search. Founded over a decade ago, Hyperion Search has helped organizations from major utilities to startups recruit their leadership teams and key individual contributors to accelerate both their growth and the energy transition. Our three main verticals are renewable power, energy storage, and e-mobility. The energy transition and the talent that delivers it has been our passion since day one. To find out more, visit hyperionsearch.com or listen to my Leaders in Cleantech podcast, available on all platforms.
But is that repricing, one layer behind that? I'm just and again, I might be way off on this, but to me it would seem, if you step back from the world, I read a great book last year called Our Dollar, Your Problem, which is a fascinating sort of review of the pros and cons of being the world's global currency and ways it's getting jeopardized. But of course, it would seem to me that if you step back, what would cause a fundamental repricing, which would profoundly impact oil, would be that, I'm making it up, right? Jerome Powell's out pressures on the new incumbent to lower interest rates. The market doesn't buy it. It's that triggers sort of, again, these things happen very swiftly. A realization, a change in perception of U.S. debt. It gets sold off. Interest rates go way up. More like a 7%, 8% on a 10-year note or whatever it might be, because they can't sell the things. That causes massive inflationary pressures. Or, the barrel of oil is still priced to dollars. It goes to it commensurately goes up. World's in a suddenly there's a big scramble on for a new world. How do markets work in this new world order? Is that an alarmist but possible?
I don't think that's, you said it, I didn't say it, but and by the way, they'd all go hand in hand. China starts to hoard the oil. India gets panicked. They everybody just grabs those ships as fast as they can. Then you realize, there's no more glut. And by the way, that could happen. It's observationally equivalent to what you're seeing today. It's mine. I want it. Let me remind you.
You want real assets, right? Whatever that scenario plays out, the minute
you see, I think everybody listening they've seen those charts of S&P versus commodities. It's a joke. These things haven't moved since 2014, 2015. The overall assets in financial markets are 3.5 times larger today than what they were in 2014. 3.5 times larger. Commodity markets are down probably around 50% since then. With gold is probably making about 25%. So now here's the point I like to make of why can this thing reprice? All of a sudden you've got how much money sitting in all those hyperscalers, and they go, we got to get out. So, there is some lost in trying to get out, but that money's got to find a new home. Where would you put your money? Real assets.
Yeah.
And so
I put it in these
incredibly
underpriced oil companies at 8 to 10p with 8% yield or whatever it might be.
And by the way, every time you go through one of these repricings, and now I thought at the time we created something new in February of 2002, we had the revenge of the old economy, and that the old economy was underinvested because new economy sucked too much capital out of it, blah, blah, blah. I'm realizing these are cycles. And if you go back, the first one I can see was the equivalent of Microsoft in the late 60s was Coca-Cola, brand, asset light, infinitely scalable, the whole idea of a brand. Low interest rates, LBJ pushing on the Fed to keep interest rates low. Sound very similar today?
Doing extraordinary things in bathrooms to step on colleagues.
Yeah. Then it was a transition. Finally, the system broke. And what was the catalyst that broke the system? It was OPEC, it was the Arab oil embargo. By the way, what was the Arab oil embargo? They didn't cut global oil supplies. They redirected it from the countries that were supporting Israel. It's very similar to what Trump is doing today by taking the oil that normally would be going to China and India and redirecting it. It's not much different. That was the catalyst that forced that macro repricing, the first big one. Then Coca-Cola got all of the big brands. The Nifty 50 in the 60s was all brand, Gillette and everything like that. That was your asset light world back then. And then, by the time you get to 1980, 81, Exxon's the king of the mountain. And I don't know where Coca-Cola was. Guess what happens? Then you saw macro repricing back to asset light, and the asset heavies guys got killed. Stayed that way all the way until 2001, 2002. This time Microsoft is the asset light guy at the top and Exxon's at the bottom. Fast forward to 2010, Exxon's at the top, Microsoft's at the bottom. Fast forward to 2022, Microsoft is back at the top, and Exxon's at the bottom. And by the way, what's happening now, though? I think what's going to happen is the asset light guys are going to turn into asset heavy. Everybody's kind of meat in the center because they're all putting steel in the ground. I don't want to getting too far off the reservation here, but I think the key point here really is these things are cycles on these macro repricing. And by the way, you look at the catalyst. The catalyst is usually some type of policy decision that gets you that way. The one in the 2001 was China's admission to the WTO. I'd argue the 70s was the the Arab oil embargo, but it's some type of policy decision somewhere in the world that creates these repricing.
And and the problem is what gets us out of the old economy into the new is, as you say, is typically has been the US and its dynamism around people willing to take and the ability to take risk, financial risk, without incurring personal and political and all the rest risk. That creates that dynamism, and that's changing. But that again, probably a different part. So 3 questions for you. One small, 2 big. One small, which is not that small, would be to say that scenario I laid out, and things are sort of hinging on that. It is a possibility as opposed to sort of a mad conspiracy theory. Does that then make Bitcoin go parabolic, or is it the Swiss franc or something? I mean, what happens? You've got all this. Cryptocurrency has gone back up. It seems to me part of a massive sort of all assets rising apart from the real ones like oil. Big bubbles. Is there? Do you have any sense? Is that a worthwhile discussion to talk about what happens to kind of these alternative currencies in that dollar inflationary world?
The thing about them is, in a deglobalized world, they're decentralized and you don't want the government touching them. But the reality is the government can touch them. It's like
they can figure out your wallet if they want to.
Yeah,
right?
They can find it. But the beauty about Precious and why Precious just goes to the moon, people are realizing the obvious. You can transact in Precious without anybody ever knowing it. You buy crypto, you got the on-ramp, and then you got the off-ramp if you want to turn this into dollars. Gold, you can take pieces of your portfolio. You can move it around.
Same goes for Flint. We'll be back to trading antlers at some point.
Yeah, exactly. Actually, there's a Russian oligarch who told me, "Why do I want Bitcoin? I'm running down this river. I got a bad guy after me. I got my buddy with me.
I want a 1911 and a bar of gold."
Yeah. All I do is pick an axe and cut my gold bar in half, give him some, and I could jump in the river and swim across. But if I have my fob's going to get wet and my crypto dies in the fob. The crypto just doesn't have that same ability, whether if it's, precious metals. The other thing about precious is, everybody talks about they know where this glut is because they got satellites that can see the ships and oil. Oil is easy to find. Nobody knows where the gold's going. You can't use satellites to track it. It's too dense. I mean, oil is a joke. It leaves a huge footprint. That's why you can see where it goes everywhere. But with the gold, no, I could point out gold is a $30 trillion market cap company or commodity. Obviously, not all of that is accessible to the market. Crypto is $1.5 trillion. So, what's the history of the market in gold? 3 millennia. What's the history of crypto? 16 years. If you're looking to hedge yourself from de-dollarization, there's nothing beats precious.
When was it that the U.S. government came and confiscated all of our gold?
Yeah, it was in the 30s or the 40s. I can't remember, but you're somewhere in that.
I was going to say, I mean, anyway. So, okay, second question.
Yeah.
So that we've just had Roland Rechsteiner on of McKinsey. He and I have sort of had this ongoing discussion that maps over this discussion around kind of, are we, this narrative of, we had 5 good years of volatility and now 24, 25, it's just 13 and 14 all over again, and we've got another 4 years ahead of us, and no one really wants to believe in that because it's just quite depressing to go back to where we were. If you're a commodity trader, that is probably fine for everyone else. His thesis is no way, just look at what's going on in the world. This isn't a progressive march towards free markets and less and less government intervention. This is the other way, supercharged. And the discussion we had was around this privileged few, right? There's a handful of commodity traders who are privately owned. They've consolidated for the most part down to 5 and sort of 3 or 4 others, or 4 and 3 or 4 others, and then you've got a small select number of IOCs, NOCs, majors, and refiners who have or are building, often with HC's help, commodity trading platforms. And the thought is that actually the window to build those is closing because of market share, particularly and talent and all the challenges. But if you have that commercial platform going into the next decade, you are going to not only obviously survive and not go bankrupt, like, as we saw when previous spikes of volatility, but also actually thrive. How do you now think about, and this isn't talking about hedge funds, this is talking about a physical merchant commodity trading platform. Is that going to be the gold star asset that every investor is going to say to that oil company or whomever, if you don't have this platform, I'm discounting you, as opposed to the obverse, which has been true time immemorial?
I think the ultimate version of it, yes, but it better be crypto and AI native, meaning your technology's got to be best in class. The old school pounding out the phones as a physical broker is not going to do. You've got to be, because let's go back to your point about the world's going to get much more complicated. You want to be able to tokenize this stuff. That's why I say be crypto native. You want to be able to tokenize this stuff and move it around in ledgers and everything like that, which is, I'm on the board of Abex, which Abex is, by the way, Abex repriced over the last year like 10x, part of it because it can do this kind of stuff. And I think, the key point here is yes, markets are going to become that much more hostile. And so you're going to want some of the most sophisticated technology, be to optimize on the asset side and optimize on the liability side. So I agree with you. It's going to be great for those that are in this, but you better be really technologically savvy because the world's getting more complicated and more complicated, just requiring a greater level of sophistication. You can't have a bunch of guys, hey, I know so-and-so in India to be able to move my nickel from point A to point B. I mean, the old story was, I extend credit to some producer of some commodity somewhere in the world. They use that credit to produce it. I get the offtake agreement. Then I've got my ability to create supplies to other people in the world, and that was the arbitrage. This time, it's going to be much more difficult to secure it, and it's going to be more difficult to find the off-takers. So you're going to want to have sophisticated technologies to be able to do this. And some of them are going to want no footprints on their gold or whatever it might be. So having a level of sophistication, I think, is going to be really critical.
Well, I think undoubtedly as well, this is a cost-based business, and if you can flip all of your middle and back office, into agentic AI, then that has some profound, positives. The one challenge, one fly in that ointment, and this leads on to the third question, of course, is going to be your sphere of operation is shrinking, right? If suddenly you're being asked to pick sides, then if you're going to work with us, you can't work in the China block. That's going to limit some of the fundamental abilities. Well, with it, I don't know, because obviously, many of these trading houses trace their ancestry to Mark Rich, and it was doing difficult things in difficult places, not necessarily with the sanction of, the US or others. I mean, what's your comment there?
Oh, you've got to be, and you're already getting two payment systems. You have the SWIFT payment system, and you have the CIPS. CIPS is cross-border international payment system. It's the Chinese ones. So everybody talks those ships are interchangeable on those dark fleets. No, they use SIPs. They don't use SWIFT. They use Chinese insurance and the rest of that. You're going to have the ability to be able to, if you're going to be a true trader and move this stuff around the world, you're going to have that ability to be able to technologically move into these other markets smoothly in and out. There will be an arbitrage. There always is an arbitrage between one system and the other, and there's a lot of money to make between those. But I think being caught in one and not in the other is going to be incredibly difficult. And I think part of the reason why the oil supply glut narrative is so big here in the West is people don't understand what's going on. They don't know enough about the other system to be able to look at the fundamentals and have any read on it.
Yeah, we're just getting this lens of kind of the Atlantic West, right?
Yeah.
Or Mediterranean West. Is this, and my final question is sort of around, this shift from rules-based to power-based politics, the kind of from free markets to mercantilism, this sort of 1905 versus 2025 kind of shift. And in some ways, as you talk, it's kind of like the Chinification of trade. The West is sort of becoming, the US is becoming more like China in some ways, in terms of policy directing economics as opposed to allowing economics to do its thing. Am I overstating the case? Where is the role of indexes and fast money and all the rest of it in that world, if that carries on, if we are in a 30-year retrenchment from free markets and increased government intervention, and everything hinges on security of supply, not cost and sustainability? Are we back to a world where I pay my originator more than my trader, and it's all about bilateral deals and owning the asset and all the rest of it?
I think absolutely yes. It's state capitalism is back, but markets at the same time, we got DeFi going on. Let's go back to tokenization. So as you start to tokenize these commodities, and now you can move them around in a DeFi system, and you start to you create a new. It helps propel the DeFi world we're moving towards. So I'm not going to say free markets are dead. In the rule-based society, the rule-based society is most likely, you can start writing your eulogy on it, because the rules aren't going to be the same on a global basis. But at the same time, you have the rise of DeFi, crypto. That's why I say, if you're going to do this, you got to do it right. You better be crypto native, because that's the way that you get around it. And I think the question is, how much of different rule base do you want to do? The one thing I like about what Abex is doing is, you create a token on this stuff. You can embed the rules of the East with the rules of the West in there, depending on where you are, so that the smart contract is written up that it deals with that, and you can move that token around. But I think the key here is, don't underestimate the market in the trading, because the DeFi system will offset that rise in state capitalism.
Okay, so I should sell my dollar, buy a.
By the way, the U.S. government's telling you to sell your dollar and buy
a barrel of oil.
Yeah. It's, by the way, the reason why they want the stable coins is so they can find a new buyer of
the debt. Yeah. But then, again, and this is always the toughest. It's the darkest hour before dawn. Your sort of the earlier discussion here was when everyone's telling you there's tons of when your bellhop tells you there's a glut of oil, it's time to buy oil. Is there, and this might be massively hopeful, if everyone's out there, including a recruiter who's a podcaster as well, telling you that we're in we've shifted to a power-based order instead of a rules-based order, that it's time to bet on democracy again.
Yeah. By the way, will democracy ever look the same as it did before? By the way, the vast majority of history is more like today and less like the period between.
Yeah, exactly. We've had this
20. By the way,
mad 20 years.
You look at the election in 2024 when the Labour Party came into power, and I think it was 2024 or 1924. 1924 UK, and when Labour power came into its rise, Labour was just like MAGA, identical. The world had a period of globalization that lasted from 1870, when the British put coal on the ships, until 1920. Lasted about 50 years. And then we went into a period of fragmentation, bilateral arrangements from, call it 1930s until 1986, 87. And before 1870, the world was all mercantilistic. So the anomaly, so call it 50 years of globalization under the British and 50 years of globalization under the Americans. And why was it? You needed one big hegemon that would bear the cost of it. And what happened was it became untenable to the British population. They got upset and sounded just like
this
MAGA.
is as soon as you spend more on defense than
exactly.
Servicing the debt is. I mean, it's fascinating as well. Like the other thing I'd just say there is kind of like, I think it was Napoleon Bonaparte, at least they say he said it, was to understand the man, look at his worldview when he was 20, right? What was going on in the world then? I butchered that quote, but everyone who's it was 2000, 2001, right?
Yeah.
Most of the current swathe of leadership in the global commodities world, their worldview, they're set in a world where everything was free markets. Hey, why should the government do this? Less regulation, the better. Let us do our thing. We'll appropriately apportion capital and interest out there. That's probably in some points why it's so jarring, is that actually they're the anomaly in the course of history, but also it's quite a fundamental mind shift about what's going on in these economies. And older people, the older generation, remember it. The younger generation have only ever lived it, right? So it was sort of a fascinating inflection point about how you deal with this.
Yeah, and I think there's a lot of truth to that statement, that the biases are deep. And by the way, the only way people change is through pain. And the adoption of crypto in a real time basis and tokenization of everything, people are still kind of afraid of it. And it'll take it was, by the way, what created DocuSign in the whole world was COVID. You were forced to use everything on that.
Yeah, Teams wasn't really used, right? Until we suddenly had to use it, right?
So forced that technology on you. I think we're going to go to a point that's going to force tokenization and crypto on the world. I don't know if I like the word crypto anymore.
Well, it's tokenization.
DeFi. It's just DeFi.
Yeah, because you're not actually talking, buying Bitcoin. Well, we had Mark Kolansky on the podcast last year, the author of Salt and Cod and those fantastic books, and discussing his book Paper, and he talks about the technology fallacy, which is this idea that a new technology comes along and change the world. The argument is actually, no, it's the opposite, right? Is the technology only becomes so prevalent when society has a need of it, right? Yep. So paper was invented 2,000 years before the Europeans started using it, and it's just because they didn't need it, right? There just wasn't that much literary society going on. There wasn't that much law and all the rest of it. It was only when that came along after the Renaissance that Europeans started using it. The Arabs were using it 400 or 500 years before, 1,000 years before, in terms of mathematics. And this is the challenge, right? There's lots of organizations that have been really trying to tokenize commodities for a long time. Maybe now its hour has come in this rather more brutal and challenging world that we're in, that hopefully, will my hope is at least we'll go back to normal pretty soon. But anyway, I don't think that's going to happen.
Yeah, Paul, I'm not on that Beaver, so.
Okay. Well, I will see you, I hope, at the FT Commodities Conference in Lausanne in April. I'm sure we'll bump into each other before. As always, Jeff, really appreciate your time. Always a fascinating discussion, and lots in there for people to unpack and listen closely to.
Absolutely. Thanks for having me, Paul.
Thank you for listening. To find out more about HC Group, our global offices, and our expertise in search within the commodities sector, please visit www.hcgroup.global.